We are back, and it is December. Markets returning from a holiday last week where things were meaningfully shortened, but nevertheless, action-packed. I'm going to see if we can't make sense of what happened and what that sets up here as the last month of the year gets underway. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And we're going to start the conversation with a breakdown of what happened last week, as we usually do. We'll take a look at the price action here and see if we can't make sense of what happened. And from there, see if we can figure out where we might be going next. It is, of course, an action-packed sort of week next week because that fateful Fed meeting that we've all been so urgently waiting for, that's coming our way. But the run-up should be interesting onto itself because, of course, now with the benefit of returning liquidity, the markets are going to be in a place, perhaps, where they're going to start to reposition or to pre-position, as it were, for whatever this might be. So let's take a look at the price action here and see how that might look, because, of course, we barnstormed higher last week, aggressive gains in the S&P, aggressive gains in the NASDAQ. And it looked really like if the mood since basically the beginning of November and really early October with that fateful FOMC meeting after which Fed Chair Jerome Powell came out and basically told everybody, you all think that it's a foregone conclusion that we're going to cut rates in December, but let me tell you, it is far from that. And of course, markets have been basically in risk-off mode since. Last week seemed like a bit of a reset on all of that narrative making. So if we look across the major assets here, what we find is that all of what we see is a bit like the inversion of that idea. So stocks were down around worries that the Fed may not cut, or at the very least may not be as dovish as desired. Well, last week they were up in aggressive form. If we take a look at the bonds, they were down. But of course, the overall story here, again, in reverse. So now we have yields coming in a little bit last week and bonds edging up, perhaps again around the idea that some of this concern is abating. Not a big move for crude oil, certainly after a 3.4% down week. A 0.8% gain is hardly anything to write home about, and perhaps says more about just how little the markets care about this escalation of force threat in and around Venezuela. But gold, again, responsive and giving us a strong 4.3% rally. The dollar down, euro up 0.7%, Bitcoin up 7.6%. Of course, it has since cratered. If we take a look at what happened here today, we're back at the lows for Bitcoin. More on that in just a moment. But the overall story here seems to all sort of fit in one tale, where stocks are up and yields are down and gold is up and the dollar is down and Bitcoin is up. And so you get this sense of risk on because risk is tied to the Fed outlook, and the Fed outlook, at least as of last week, was shifting back into a mode that the markets were more comfortable with, largely because it had spent weeks upon weeks going in the opposite direction. And without really one catalyst or another last week, certainly not even in the lead up, it's not as if the Fed changed its tune materially. We got a few comments from Fed officials that were maybe evocative of more of a cut probability, but hardly anything that we haven't heard before. But for whatever reason, the markets decided that last week, going into the holiday, perhaps, going into diminished liquidity, perhaps, the markets were going to be in correction mode. And they were going to say, okay, whatever we were doing since late October, we don't want to hold that bag over the holiday, so we are going to put all of those dynamics in reverse. And that's seemingly what last week boiled down to. Now, interestingly, if we look at where Fed policy expectations now sit, they haven't been so terribly changed in recent days, and that seems to kind of lend credence to this idea that it wasn't so much a change of substance last week as it was the markets opting to de-risk exposure on a week when there wasn't a lot of liquidity, there wasn't a lot of conviction, but there was every reason to be concerned, because if some headline were to come out of left field and challenge the narrative, there wasn't really a lot of participation, and markets could get very jumpy when there are so few buyers and sellers in the fray because of the holiday. So if we look at the substance of the matter, we can see here a week back, we were already in a place, this is at the start of last week, already in a place where the likelihood that we'd get a rate cut in the December 10th meeting was north of 80%. It has held there basically ever since. Now, if we look a month back, of course, it's just a touch over 60. So we can see that there's been something of a shift here. But the meat of what we saw last week, the sort of relentless risk recovery, by Monday, that was already there in the outlook. And so it's curious that, of course, the markets were as dramatic in their adjustment as they were. And that perhaps speaks to this idea that maybe this wasn't really a shift in sentiment so much as it was an adjustment in positioning around the possibility that, look, we have this major story alongside diminishing liquidity. Let's not front run anything. Let's instead reduce exposure, de-escalate, and come back after liquidity has returned and see where we land. And where we've landed is not incredibly encouraging. The start of the week here, certainly not anything shocking or dramatic, but the dollar having been back overnight to the lowest levels since mid-November, so call it 2 weeks, now closing the day flat against the euro, a little bit higher against the pound, a little bit higher against the Aussie, a little bit higher against the Canadian dollar. The yen, of course, still doing its own thing here, so the dollar is a little bit weaker there. That seems to have more to do with domestic Japanese concerns than it does with anything else. But elsewhere, it is a story in the opposite direction. Yields are higher. Metals are not exactly surging here, especially looking at gold. Silver is faring better, but gold is up only about 0.3% on the day and struggling to make hay above that mid-November high. And so the story here as we start this new month and as we start this new week seems to be that the momentum from last week's correction has been sapped. We're finishing down 0.5% on the S&P, down 1/3% on NASDAQ, down 1% and some change, almost 1.1% on Russell. And of course, the ailing instrument, the ailing risk asset of the bunch, Bitcoin, and crypto in general, but certainly Bitcoin, off 4.7% and back to where it was on November the 21st, which is when it bottomed, before last week's tepid attempt at a rebound against this backdrop of overall risk. And I say tepid, even though obviously the move here was quite significant. 7.6% was last week's move in Bitcoin. But when we put that 7.6% rise in the context of a 10.4% decline just the prior week, we obviously see that this is a market that, despite the magnitude of the move, was only just correcting and couldn't even erase the preceding week's decline, never mind the 36.5% decline from the high on October 6th down to that low on November the 7th, or the week of November the 17th, so the week before last. Now, as far as the data here is concerned, and this is where sort of the motivations for these moves become interesting. We started the week here with some questionable data out of China. We can see back to contraction mode on the official PMI numbers here for November. So the world's second largest economy back to shrinking mode. As ever, PMIs are done in terms where 50 is neutral, neither growth nor contraction. Above 50 is growth, below 50 is contraction. The further you go in each direction, the faster the pace. So the further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. We can see readings below 50 across manufacturing, services, and overall. We, of course, also get the first batch of this week's meaningful U.S. data, the ISM Manufacturing Index. We still don't have any quality government data of substance that's current, but looking at these third-party indicators here, the Institute for Supply Management giving us a little bit of a clue here. So we can see 48.2 ends up being worse than expected, and of course, deeper into contraction territory for U.S. manufacturing. If we take a look at the way that this thing was breaking down, we can see new orders falling deeper into contraction territory, employment deeper. So both of these are now falling at an accelerating rate. Meanwhile, the inflation component is actually picking up steam when we look at the November data. So when everybody was hand-wringing earlier in the year and saying, well, where is this stagflationary risk from tariffs that everybody keeps banging on about? Well, there it is. So obviously it didn't all happen at the same time, and obviously things have been quite uneven, but even going back to the start of the year, we can see here the adjustment was lower on new orders, lower on employment, and then much higher on prices. This was the response to the onset of the tariffs at the start of the year. We can see prices have since cooled, and these issues in new orders were almost trying to recover. That's ultimately failed. Employment has been trending lower the entire time. So we can see businesses are retrenching. Since this shock at the start of the year, employment has steadily deteriorated deeper and deeper into contraction territory. Now, we're going to get the bigger deal service sector report later this week. That's one of the main touch points for sentiment this week. 52.1 expected on that services index. That would be a little bit softer than the prior month, but still very much within the realm of this range that's prevailed late last year and into the beginning of this year. And the key question, of course, here will be, will the service sector continue to be able to carry the economy here? Because, of course, if this story on the employment side in manufacturing is telltale, well, then consumption is going to be impacted adversely, and 68% of the U.S. economy is household consumption. So to the extent that services are being held up by consumer spending, we have a story here where we might very well be in a situation where, as ever, the economy moves slowly. It's a barge and not a speedboat in terms of how long it takes to turn around. But we could finally be seeing those stagflation risks that we were getting warned about and that everybody was kind of hand-wringing about when the tariffs initially arrived. Now, to the extent that we're watching consumer confidence, of course, the other main thing here on Friday is going to be the December consumer confidence report, where we're expected to see a little bit of an improvement on the main headline index from 51 to 52. Now, we can see here that sentiment has been in an unwelcome decline. Here's what that consumer confidence index has looked like so far. And perhaps the most worrying part of all of this is that over the past 4 months, sentiment has been deteriorating even as inflation expectations ease. This was really a one-way bet for a long time, going all the way back to the beginning of 2021, the relationship between sentiment and inflation, where we can see here's the post-COVID inflationary spike. Obviously, consumers didn't like it. Early 2022, the Fed starts to aggressively hike rates and inflation expectations fall. Sentiment improves. At the start of this year, we get the threat of tariffs. Inflation expectations spike by a whopping 4% here, from the lows up to the highs in the first quarter of the year. Sentiment craters. Inflation expectations come back in. Sentiment seems to steady, but over the past 4 months, it is deteriorating even as inflation expectations cool. So something is clearly misfiring here with the most significant engine of U.S. growth, and we're going to have to look at that here as we look at this ISM data, because yes, the Fed is expected to cut rates. Markets clearly still want a lot more rate cuts out of them than they've owned up to, and they are going to be updating their September forecasts in the summary of economic projections at this December meeting. This now may be the bigger deal than the cut itself. Of course, we can see back in September, the Fed projected this December cut. In September, the baseline Fed funds rate, the median, was 4.4. Down to 3.6, narrowly, is 3 cuts. So the Fed already told us in September, with 2 meetings after September left, and a cut already done in September, that there's 2 more cuts after. Let's see if we can do that math. Oh, there's 2 meetings left for the year. Oh, there's 2 more cuts on the board. Gee, I wonder what the Fed is saying. So, although the December cut may be controversial, we certainly saw that in the discussion in October, it's not as if the Fed didn't tip its hand on what the likely scenario is. The larger issue is what happens next year, because there the disconnect continues to be wide. The Fed's only got a single rate cut for 2026. And if we take a look at what the markets have for them, despite the fact that they've kind of diluted expectations a little bit, we're still looking at 61 basis points. That's at least 2 cuts and 11 basis points in the direction of a third. Now, that's somewhat less aggressive than what we've seen it look like recently. That's only about a 44% chance of that third cut, so call it just slightly shyer than even. So maybe the markets are getting a little bit fuzzy about that third cut, but in any case, they are way more dovish than the Fed has accounted for. And so to the extent that we're looking at a situation here where growth starts to perhaps show more signs of wear and tear, if there's not visibility into that from major economic data, and all we start to see are these third-party indicators kind of tip us a little bit in this direction, we're going to start to see the markets probably respond to those. But the range of response is inherently limited because they are already so dovish relative to what the Fed has said, then that the stage seems almost set for disappointment. If any of these numbers are anything short of awful, if they're relatively as expected here, and these expectations are by no means aggressive, what we're looking at here is a little bit of a cool down in services, a little bit of a pickup in sentiment. If we get anything that's meaningfully steady here, we probably get some disappointment around what the Fed might actually signal. There's also a euro area inflation reading, but the ECB is not priced in to change policy at all next year, so this seems like something of an afterthought. In any case, if we look at what S&P Global PMI numbers have shown us so far, they're suggesting that the economy is in relatively solid health. So perhaps that gives us a service sector number that's relatively upbeat for ISM, or at least foreshadows as much. But that, of course, would stick in the market's craw, as it were, because what they want is rate cuts. And a solid ISM number would diminish that likelihood. We can see that clearly here. Once we get the October cut and the Fed comes out and gives it, but Powell says, don't hold your breath for December, the market's top, and they've been heading lower ever since. Here's the Thanksgiving week recovery. It fails to break any of these highs and basically stops at the same spot where the post-Fed hangover left them. If we look at how the dollar is performing here, it's cooled again last week against the backdrop of the sentiment improvement, but still in the uptrend and still holding its former range bottom. So all of this seems to be making the case that last week was the correction, and this week perhaps the resumption of what was started in late October. So as far as exposure goes here, I'm still a little bit long gold. That's working here. A little bit long silver also. That's working. I peeled off half of my Bitcoin short. That's been an excellent ride. I've been holding it for weeks now, and I peeled off half because we got back to the low, and it seems like things can get a little squirrely here. So I took half. I also took half on my exposure in EWZ. This is the Brazilian stocks ETF. It seems to be back at its swing highs today. And if I'm expecting risk off, then that's good enough for now. I have another piece here with expirations in January. We'll revisit that then. Still long the dollar. A bit of relief there today after last week's pain. Aussie, pound, and euro. I have all of that on the short side. Still short risk via this put vertical in SPY. Still long the bonds via call vertical in TLT. and still a little bit short crude, Venezuela notwithstanding, although I only have 18 days to expiration here, and the trade isn't really making much headway, so I might have to start to think about what I want to do here next. That might be decision time this week. And that is Macro Money for today. As ever, we are here Monday through Thursday after overtime, a show I co-host with Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.